All right, heroes, here we go. Module 9, trade size. Now, if you have been reading about investing before or trading before you met me, or purchased Market Hero, or read any of my blogs, seen any of my videos, it's probably unlikely that you've really heard a lot of people talk about trade size. Um, Taken from experience and doing a lot of studies, trade size actually makes the world go round. We've talked about a lot of really, really cool things so far in this course, advantages that we have, an edge in the market, how to take that edge and expand upon it. But the reality is, trade size is the single most important part of investing after liquidity. The reason that liquidity is still the most important is because you want to always be trading the most liquid products that give you not only fair market value, but as you know now, the probabilities that come with it and that we will be trading off of to make a ton of money only happen in the most liquid products. But the reason that liquidity is more important than trade size is because with trading and investing in illiquid products, you're going to get your ass handed to you. You're going to have to pay up money and take an immediate loss just to enter a position. So that's no good. So I want to talk to you guys about trade size. And the truth is, everything that we've spoken about thus far, right, from the expected move being overstated and thus options are overpriced, and then how selling options when the expected move is greater than average is even more advantageous, and then how managing our winners and letting our losers run, which again is the complete opposite of conventional wisdom, gets you even more money. And then on top of that, we want to be in a lot of non-correlated assets because diversification is a bunch of bullshit. The truth is, all those probabilities that we have shown, all these studies that we have shown, everything that we've shown thus far does not happen if you don't have proper trade size. That's why it's so important. It is so important. Proper trade size will ruin everything. If you don't have proper trade size, you will ruin everything. If you have proper trade size, everything that we have talked about thus far in Market Hero and everything that we're going to talk about moving forward will absolutely happen for you. Will absolutely happen for you. So remember how we started off Market Hero? We talked about this idea of a coin flip bet. So I'm going to give you $1,000 worth of cash with 1,000 singles. And I have a coin in my hand. It looks like a penny right there with Honest Abe on the front. And I say, okay, you get to bet me any amount of money, no matter what, I'll match it. And we're going to bet in the coin flip. Heads, I win. Tails, you win. Now, when we did this many modules ago, a lot of you are probably saying, well, Steven, why the hell would I make that bet? Why would I make that bet? Because it's a 50-50 shot. So I don't even want to waste my time because at the end of the day, we're going to break even. Now, some people would say that. Others would say, well, I'm just going to bet you a lot because it's a 50-50 bet and it's a shot in the dark, so I'll see what happens. Well, the reality is, on these 50-50 bets with flipping a coin, you could have 10 losers in a row. You can absolutely happen that. You could have 5 losers in a row and it won't be actually that challenging for it to happen. So again, and we'll get into statistics on that specifically here in a minute, but again, no one would bet me on that. But then I said, well, what if the face of Abraham Lincoln here on this penny was a little bit heavier and that it would actually have heads be face down and tails face up about 51% of the time, right? So if that was the case and we had a little bit of a weighted coin, what would you do? Now, again, a lot of people would say, I bet big because I have a better than 50% chance of making money. But the smart people will say, I'm going to bet you the minimum amount possible. And the reason I'm going to bet you the minimum amount possible is because I'm going to get the number of occurrences required so that I'm right 51% of the time, and I'm literally going to be a printing press at that point. So that's what the smart people are doing. And if you've been paying attention at all during Market Hero, which I know you can, which I know you have been, excuse me, you're seeing that over a 27-year period, we're making a lot of money in this. Over a 5-year period in some of these studies, whatever study we've been doing, over the long run, we've made money. And the reality is, we've had an account. We haven't blown up our account before those studies have been over, before those studies finished. And the truth is, you need the right number of occurrences to make this money. If we're going to place a trade where we're right 60% of the time. We can be wrong a couple of times in a row before we're right at the end of the day 60% of the time. You need enough occurrences. You need enough of a sample size to be able to do this. That's why trade size is so important. So if we go back to this example with the weighted penny and the dollar, the smart people, and I know you are one of those smart people, you market heroes, are going to bet me $1, the minimum amount possible every single time, so that we do this till you absolutely bankrupt me. If you bet me $1, your chances of staying around and your chances of making sure that that 51% win rate is going to come through go up the more bets you make. So the more bets you can make the more bets with the smaller betting size. So that's why trade size is so important. It's so important to stay small. If you think there's a great chance or a really high probabilistic trade or a trade that you think is going to be so profitable for you, too bad. Money is made hand over fist in the stock market. I'm telling you, I'm a millionaire right now. Money is made hand over fist in the stock market. However, it is not made overnight. It is not made by making big bets. It's by making a lot of small bets over and over again with strategies where we have a pretty big edge. That's how you make a lot of money. You want to be a millionaire in the next decade. You want to retire 10 or 20 years earlier. This is how you do it. You do a lot of high probability trades where we have an edge that are very small, so that the numbers that we think we're going to have come out to be true at the end of the day. So let's do some simple math here, people. Let's say we have a portfolio comprised of 5 positions, right? 5 positions. Let's say Apple, Google, Netflix, Microsoft, Yahoo, right? And each of those positions gets 20% of the total value of the portfolio, right? So we have $100,000 in the portfolio. We're going to put $20,000 into each of those 5 investments. And we decide to buy stock with each of those positions. What are the chances, mathematically speaking, just pure math, right? Because again, this thing's a pure math game, that the account goes to 0 and goes busto. So this is interesting. Let's break this down here real quick. If we buy 5 stocks, what are the chances we're going to make money in each of those positions? If you don't know the answer to this, you have to go back to module 1, which is markets are random. And we have a 50% chance of making money on each of those stock positions. Why do we have a 50% chance of making money on each of those stock positions? Because stocks are priced off of 2 things. Forward earnings, which we cannot predict, and the risk-free rate of return, which right now is 0. Because of that, markets are completely random, right? So you have a 50-50 shot of making money on each of those positions. So if you have a portfolio of those 5 stocks, each with 20%, what are the chances that your account goes busto? It's actually 1 in 32, which isn't like a crazy number. That is relatively unlikely. That's about 3%. But again, I don't want to have a portfolio where I have a 3% chance of literally going for broke. I don't want that. So let's expand on that a little bit. Let's say we had a portfolio with 10 positions now, right? And each of those positions gets 10% of the total value of the portfolio. And again, we're buying 10 stocks here. So each of those 10 positions collectively, each of them have a 50% chance of making money. Again, why? Because stocks are priced off of 2 things. Number 1, they're priced off of forward earnings, which we cannot predict. And number 2, the risk-free rate of return, which right now is 0. Right? So again, we have 10 50-50 shots in this portfolio. When we had 5 of them, it was a 1 in 32 chance the account was going to go to 0. Now it's 1 in 1,024. So this is the power of staying small in your trade size. All we did was go from 5 positions to 10. All we did was go to 20% allocated to each position to 10% allocated to each position. Right? That's all we did. We didn't do anything else. And we took our odds of going broke from 1 to 32 to 1 in over 1,000. That's a big deal. And you're starting to think now, you want these probabilities to come out. You want to make the kind of money you want to be taking. You want to be right X times out of 100. This is how you guarantee that happens. Now, what if we take it a step further and we said, you know what, we're going to cut those positions in half now. So now we're going to buy 20 stocks, each with 5% of the portfolio allocated to it, right? So with each of that, we still have 20, 50, 50 shots, but mathematically speaking, we have a 1 in 1,048,576 chance of going broke. This is some really powerful stuff. If you don't understand the gravity of how powerful this stuff is, think about it. You went from 5 positions and having a 1 in 32% chance of having no money after it's all said and done, to 10 positions and having a 1 in 1,000 chance. Now that you have 20 positions, you have a 1 in a million chance of losing your entire portfolio. The longer you stay in the game and the more high probability positions we put on where we have an edge, the more money you're going to make. So that's just some simple math, but we're not done there. So again, buying stock. Buying stock is a 50-50 chance of making money. Why? And I've said this a lot. I'm going to say it again as long as you know me, because again, you have a lifetime membership to everything Market Hero. I hopefully will be around for the next, 80 years, whatever it is. Hope to live well over 100. You will hear this till you're blue in the face. Buying stock right now is a 50-50 bet. The reason for that is because stocks are priced off of 2 things. They're priced off of, number 1, forward earnings. We cannot predict forward earnings. There's too much randomness that will go on. There's too many things that we cannot predict that will happen. CEOs get fired. The price of currency changes. Gold changes. The Federal Reserve raises rates. There's too many things that go on where you can actually, perfectly price in the forward earnings of a stock. So we throw that out. And the second thing is the risk-free rate of return. So the risk-free rate of return is the most amount of money you can make right now with zero risk. That risk is added on to equity prices over the course of a year to pay investors for taking the risk of being in the market as opposed to just putting it in the risk-free account, right? So if we buy stock for a 50-50 probability of making money, what are the, here we go. So the chances of 1 loss in a row are just 1 in 2, right? That totally makes sense. Just 1 in 2. What are the chances now we have 3 losses in a row? 1 in 8. Okay, getting a little bit better. What are the chances we have 5 losses in a row? 1 in 32. And then what are the chances we have 10 losses in a row? Right? The chances we have 10 losses in a row are 1,024. So if you remember here, if the portfolio where we had, again, in that portfolio where we had 5 positions, each with 20%, those are 5 chances of a loss. That's why there's a 1 in 32 chance that we lose our entire account. And then, again, like we mentioned last time, when we have 10 positions, we have a 1 in 1,024 chance of actually losing all of our money. That would be 10 50-50 bets or 10 just buying stock outright positions gone wrong. Let's take it a step further because, again, we don't do 50-50. One of our big rules is we're not going to ever do anything that is better than 50-50. Right? So 67% chance of making money. So how do we place a trade where we have a 67% chance of making money? So let's go to SPY, right? If we want to place a trade where we have a 67% chance of money, we can sell a 33 delta put. 100 minus 67 is 33. So we could sell a 33 delta put. So what this says when we sell a 33 delta put is SPY, just as we see it on the screen right now, SPY has a 33% chance in 32 days being below 243, where everything is right now, right? So the opposite of that is 67. So SPY has a 67% chance of being above 243 at the time of expiration, right? So that's all that is, nothing crazy, and you guys know this. So again, for a 67 probability chance of making money in a trade, right, we could sell the 33 delta call or the 33 delta put. So chances that we lose 1 time in a row, 1 in 3, right? Of course. Chances we lose 3 times in a row, 1 in 27. Okay, that's nice. Chances we lose 5 times in a row, 1 in 244. And then ultimately, chances we lose 10 times in a row is 1 in 59,000. So if we go back to our 50-50 bets, which again are just buying stock outright, the chances of losing 10 of those 50-50 bets in a row is 1 in 1,000. But if we just up our odds of making money to 67%, we have a 59 times better chance of preventing 10 losses in a row just by making a trade that gives us a 67% chance of making money as opposed to 50%. Now, the big thing in here is how do you make sure that you prevent these losses and that this is your worst case scenario? By having small trade size, right? Now, what about 75% of making money? So how do we place a trade where you have a 75% chance of making money, right? Again, 75% chance of making money. What we could do is we can buy a 75 delta call, or we could sell a 25 delta put. So we don't have a 25 delta put right now or a 25 delta call. Let me see if I can go find one for you guys. 24, no. There we go, 25. Great. So if we were to buy the 252 call expiring in October, what are the chances we make money on that trade? Remember, the delta for an option are the chances an option finishes in the money. If we buy an option, we want the option to expire in the money for us to make money. So what this is saying right now is there's a 25% chance SPY finishes above 252 67 days from now, right? The other side of that is there's a 75% chance it doesn't, right? So selling the 252 call or a 25 delta call or a 25 delta put gives us a 75% chance of making money. No big deal, right? So again, for a 75 probability of making money trade, right, as an example, selling a 25 delta call, the chances of 1 loss in a row are 1 in 4. The chances of 3 losses in a row are 1 in 64. The chances of 5 losses in a row, which is like the craziest thing ever, we made horrible decisions, horrible decisions, is 1 in 1,000. And then if we literally closed our eyes and just clicked buttons on a 75% chance of making money trade, right? If we just click button, the chances of 10 losses in a row are 1 in a million. Now, this is what I'm talking about, guys. And again, the way we make sure that this is our worst case scenario is by staying really small. Because remember, we have a 1 in 4 chance of losing money on a 75% probability of success trade. If we have too big, we have a 1 in 64% chance of having 3 losses in a row, and at that point, our account could go completely busto. So again, if you want 10 losses in a row, worst case scenario to be 1 in a million, you have to have really small trade size. Now here's the really fun one, guys. A 95% probability of making money. Okay, guys, you should know this. How do we place a trade where we have a 95% chance of making money? Well, what we could do is, let's look at this 258 option, right? A 5 delta on the 258 option means a few things. So let's go through them. Number one, it means SPY has a 5% chance of finishing above 258 67 days from now. It also means that the 258 call has a 5% chance of finishing in the money at expiration. It also means that the market is currently pricing in a 10% chance of at some point in the next 67 days, SPY trades up to 258. Now, how do we get that? The chances a stock touches a price is double the delta. So that's how we got that. So now if there's a 5% chance that the 258 call is going to be in the money at expiration, there's a 95% chance it does not, right? So if we sell the 258 call, there's a 95% chance we make money on that trade. Very simple, you guys know this. So what are the chances of 1 loss on that trade? 1 in 20, not bad, right? What are the chances of 3 losses in a row? 1 in 8,000. What are the chances of 5 losses in a row? 1 in 3.2 million. Now, if you're placing small trades that give you a 95% chance of making money, what are the chances of 10 losses in a row? 1 in 10.2 trillion. So again, it's so crucial. So crucial that you trade really small. So, as a rule of thumb, and I need to make a new slide I could see here. As a rule of thumb, we're going to set a rule here. I'm going to put this in all caps. No trade can take up more than 2.5% of the total portfolio. That's how you spell it. Now, why are we doing this? If we put the screws to you guys and say, hey, you cannot allocate more than 2.5% of your entire portfolio to any position, that means that all your probabilities, right? Selling options because they're overpriced, selling them at the right time when the expected move is greater than average, managing your winners so that you can double your profits. All of those things, placing trades where you're right 95 times out of 100. All of those things can and will happen for you if no trade takes up 2.5% or more of your portfolio. So again, staying small in our trade size, guarantees that the probabilities that we set out to have come true, and that the edge that we know we have over the long run plays in our favor. So that's what staying small is, guys. Nothing more than 2.5% per position. I'll see you guys in the next video.